Hey everyone, it's Paul with this week's video, and we have an incredible, exciting topic today. Mix of macro and micro today. Just going to change things up a little bit. So, three secrets to big gains in 2023 and beyond. And you'll see once you watch this video why I phrased it that way. T-shirt check. Listen, folks, stock market, not rocket surgery. It's not rocket surgery. If you're willing to have a little patience. All right, disclaimer time as usual. This video, any content from my company, ATG Digital Media, my tweets, Substacks, Instagram, all social media, not investment advice. It's your money, it's your responsibility. Past performance not equal to future results. My team, we can make errors, mistakes, have oversights. Capital loss is a likely outcome. It's true for trading, speculating, investments. In other words, nothing's guaranteed, nothing is certain. Also, the owners, contractors, employees associated with ATG Digital Media own, trade, transact in the investments that are mentioned in these videos and in any of our content. And before I get going, just want to quickly plug my company, atgdigital.media. That's the website. If you like the sort of approach, direction, thought process that underpins all of the videos that you watch on YouTube, or if you follow me on Twitter, well, check out subscriptions at atgdigital.media. Subscriptions begin at $9.99. We focus on what I call OGI, opportunity, growth, and innovation. We are future looking. We look to the future. We believe that these investments are where you are going to make the biggest gains in 2023 and beyond. Also, if you don't want to subscribe yet, but you want to read and check out, hey, this is the process, this is the way, and we write about stocks and crypto, and we actually give out the names of these stocks and crypto. We don't hide it or tease it or anything like that. You can also check out my Substack, paulmampilli.substack.com, and that is absolutely, completely, and utterly free. All right, on to this week's video. All right, we had essentially an era come to an end, and you can know this by the fact that interest rates sort of like, some people will say that, interest rates are like what gravity is to physics is what interest rates are to financial markets. And the fact that we have gone from essentially zero to about 4 or 5% for short-term interest rates, and it does not look like interest rates are going to come back down, which in my judgment, in my opinion, and remember, this video, it's opinion, it's information, engagement, entertainment, not advice. But in my opinion, we are in a new era for markets. The last year sort of begins like with interest rates starting to go down, starting sort of the early 1980s. And it ends somewhere in 2020 with what happened with COVID. So we're in a new era for markets, which means you got to think differently. You got to really kind of you can throw out sort of all the most recent periods of time of corrections and recessions, and you got to really kind of think originally. Yeah, there's some aspects of history you can take, but very little of it really from the last sort of period, because that was a period obviously where interest rates were in decline, and we no longer have that. Now, many people think that, well, it must be the opposite. In other words, hey, we're going to have high inflation. But you'll see that's actually not, that is not what is unfolding. We're actually in this period where we have high interest rates, low to declining inflation. And Dean, you can put up that trueflation chart just so folks know what trueflation is. This is a blockchain crypto-driven inflation measurement indicator, and I have found it to be actually ahead of CPI and PPI, and it is telling you that inflation is declining and somewhere near the sort of under 4% territory and in decline and continuing to decline. I believe that over the next 12, 24 months, you are going to get back to inflation that it was what we had prior to 2020. So like, in that 2% to 3% range. But interest rates are going to stay high. The other thing that's flummoxing, yeah, big word, flummoxing, is that normally into a period like this where you have high interest rates and where there's a growth slowdown, you tend to have rising unemployment. But it's flummoxing because right now we have low unemployment and rising wages. There are a number of professions, places where incomes are going up, and that is driven by this mix of what has been sort of going on for a number of years, which is declining fertility. In other words, people having fewer kids all around the world, and that's been true for decades. Then we've also got COVID, which has really tragically killed millions of people around the world, which has, altered the demand and supply balance for labor markets. And then we've also had retirements. We have an aging world, and a lot of people chose to retire post-COVID, and that has driven this, which is, in other words, there is constant demand for labor, which is then driving rising wages. So that's pretty different. And then because of some of those same things, population declines, there's just low growth. It's hard to find base growth. Growth is often driven by the fact that there's more people, there's more demand. So a new era for markets. All right, there's a part 2 to this. Actually, truthfully, there's a part 3 for this, so stay tuned. We've seen a period of time for 30 years, 40 years of rising asset prices that have been driven by low interest rates to some extent. And we don't have that. And without that, any number of assets that were really debt supported. In other words, you could go borrow money at, let's say, 1% and 2%, and then buy up some asset, and then somebody else would come behind you and they would borrow money and they would come and buy this similar assets and bid it up, because assets tend to trade as an asset class, and they would bid it up. Well, that game is over. We are going to see low to declining asset prices for debt supported assets. What are some debt supported assets, especially over the last 15, 20 years? Well, one of the biggest debt supported assets are dividend and buyback driven stocks. In other words, these very well-known so-called blue chip companies that have been able to borrow from bond markets at very low rates, 1%, 2%. And what they have done is they have borrowed and they have paid out dividends. They have borrowed and they have bought back extraordinary, immense amount of stocks. I have seen estimates as high as $900 billion to over $1 trillion for this kind of activity. And when you go and look at these stocks, you can see, especially since 2008, I mean, these stocks are a straight line up. I mean, they have gone up massively. And we're talking about the Procter and Gambles of the world, and Campbell Soup and General Mills, and really well-known, considered to be super, super safe stocks. But those stocks really have been bid up by the underlying activity that was driven by low interest rates, borrowing in the bond market. So these companies, when you go and look at their balance sheet, debt 10 years ago, 20 years ago, almost nothing. In other words, these companies were genuinely blue chips. They generated extraordinary amounts of cash flow. But that's what allowed them also to buy to issue bonds at very low rates and then pursue this activity to, in my judgment, it's an extreme. So now they've got all this debt that is sitting on their balance sheet, but it's no longer at 2%. They now have to pay 4 or 5%. And so Now, they can no longer borrow at those low rates, so it doesn't make sense to do this anymore. So without all of that support, without that dividend support, without that buyback support, these stocks from their current prices, yeah, I mean, in my judgment, in my opinion, it's going to be a very, very tough period of time. Another asset that is supported by commercial real estate that represents, by what I have read, as much as 40% of regional banks, small and medium-sized banks, commercial real estate. We're talking about office buildings, or we're talking about multifamily housing, commercial real estate supported by debt. And so this is going to be a very tough place. So you've got real estate investment trusts, you've got the banking sector highly exposed to this sector here, and that's going to go through a workout as well, no different than the previous category of investments. The other place where you've seen the low interest rate debt really make a difference is in government spending. As you know, we've got the debt ceiling issue, crisis, if you will, going on. But the truth is that you can go around the world and debt has just gone to like crazy high levels. And the IMF in 2021 put this out, $226 trillion worth of debt. So there is a lot of debt sitting out there in the world that was driven by the fact that interest rates sort of like was seen as sort of a one-way trade. You could just borrow as much as you want, interest rates would never go up. And then things changed. The unexpected happened. COVID happened, all the other things happened, and boom, we are suddenly now in a new era for markets. So what's my playbook for this new era for markets? Well, I kind of want to stay away from the central issue of today, which is what? Debt. You want to go through all of your investments and be like, hey, how much debt do you have? Because when you reprice it for 4 or 5%, or maybe more, 7%, remember 4 or 5% is something you can now get by doing nothing. You can just go buy a money market fund and get 5%. You could go to various banks and they will give you 3 to 4%. You can buy treasury bills and get 4 or 5%. So that's like this hurdle now, right? So if you're any company, you have a risk level that is higher than the US government. The US government has the ability to tax, so it's seen as being essentially risk-free. So everyone's going to pay something on top of that. So if you can get 5% in treasury bills, and even if you're the safest company, you're going to pay something on top of that. So maybe 5.5%, maybe 6%. And if you've gone from 0 in debt to 10 billion in debt, well, you're talking about a hefty bill that you're going to have to pay as you refinance those bonds that you were able to issue at whatever, 0%, 1%, 2%. Yeah. So you want to minimize your access to exposure to assets that have, debt. So no debt would be ideal. Low debt, might be okay. If you've got cash flows that can pay off debt, well, that low debt can be paid off, so no big deal. Some of the companies that I focus on, so opportunity growth, innovation companies, they have some debt, but when you go and look at them, you'll see that that debt is tied to their stock prices. And so that is something that is a bit different, because if I am right, and I've been writing about this and talking about this on this channel for a while, which is that you're going to see, opportunity growth and innovation asset prices lift. And so they will have a chance to simply convert that debt into equity. So this, in my judgment, in my opinion, not a big deal. So the other thing you want to do is look for companies that can cut prices to gain market share. Now, for the last couple of years, the so-called, the Wall Street's been telling you like, hey, you want, recession-resistant companies. You want companies that have pricing power because, during inflation, they can lift prices. Turns out, well, not yet turns out. In my opinion, when you look back at 2023 and say, hey, what should you have been buying? This would be more important. Why? Well, hey, Look at what Tesla's doing, right? Tesla has cut prices, I think, 3 times in 2023. And why are they doing that? Well, they've got high margins, so they can do that. Why do they have high margins? Well, because they've been investing for innovation to cut prices and gain market share for, the last 7-10 years. And so what is going to happen to GM and Ford and the other legacy automakers? Well, they've got to support their old business of making, gasoline and diesel-based engines and cars and trucks, but they've also got to somehow find a way to compete with Tesla in the EV business and make investments for autonomy and any other, growth areas. And they just can't do it. You can't do it because, hey, Tesla's got the margins to be able to cut prices. And the legacy companies have massive debt. So when interest rates go up, well, how are they going to get the money to invest for the future? They can't borrow from the bond market because the price is too high. They got to pay back their debt because interest rates are at very high levels. So you can see that's a workout scenario. So you want to avoid companies that can't cut prices. I mean, they got to be able to cut prices. The only way they can do that is if they have been investing for innovation, because innovation is always deflationary. Nobody goes out of their way to pay more for anything. So any innovation in the end has to deliver some mix of low prices, convenience, greater access. Yeah. So that's the playbook really for 2023 and beyond. What assets would you want for this new era in markets? Well, hey, you knew I was going to put this there, but still, it's true. Just because I've been saying it doesn't make it false. You want growth stocks that don't need debt, that don't need additional investor support. In other words, they don't need to keep going to the markets to raise equity. And that is something that many growth stocks have done, because when the bar of interest rates was very low, investors are looking for higher returns and willing to take more risk. But today, with higher interest rates, they don't need to do that. So they are not going to support companies that cannot be self-generating in terms of resources, in terms of cash, for what they do. So the other place is crypto. And we've gone through, a couple of crypto cycles that have been very much speculation driven during a period of time when interest rates were very low. Now we're going to have to look at cryptos really as sort of like businesses, as business entities. And in the end, when you look at cryptos, I mean, they are a network, and a network, that has significant costs. So you're going to have to go do business analysis and be like, hey, find tokens that are underpinned by blockchains or networks that support some real economic activity and that can scale up without them having to issue more and more tokens. So you can see this new era for markets is going to actually require some new ways of thinking, some new ways of approaching things, and it is not going to be the same as what happened before. The third place, I would say, is truly scarce assets based on finite quantities that really can't be replicated or manufactured very easily. The obvious one in the OGI world is obviously Bitcoin, but in, let's say, the real world, it might be something like land. It might be something like that. All right. I'm not going to go into a lot of assets, but I want to, leave you with some ideas of like, what does this look like? What kind of stocks and what kind of crypto would that look like? Well, here's 3 obvious bets for this new era in markets. I mentioned Bitcoin already. Why? Hey, well, this is finite. It's globally known. It is a store of value. It is emerging as a greater and greater store of value around the world. And as we go through this period where there is this debt-driven deflation and bust that unfolds, people will want to store their value in something where they're like, hey, so many assets are going on sale as banks dump commercial real estate, as other companies try to sell businesses to try and generate cash to pay off debt. People are going to seek out a store of value that they feel that they can see and believe. And remember, the blockchain, verifies that is actually finite, because there's going to be a lot of assets for sale, which makes something like Bitcoin incredibly valuable. Tesla, why Tesla? Well, I mentioned earlier, they've been investing for innovation for almost 20 years. So they've got the benefits of innovation, and the benefits of innovation are that costs go down. Their cost of batteries going down. Their cost of manufacturing cars going down. So they can cut prices. They can cut prices to take market share and effectively wipe out their competitors. And anybody even starting new has to deal with the fact that interest rates are much higher. So Tesla is in this incredibly powerful competitive position today, and they are doing all the right things by cutting prices to take advantage of their position. Now, the third one I debated quite a bit. Said, oh, what should it be? Should I pick Zoom, or should I pick Airbnb, or Square, or which is called Block? But in the end, I went with healthcare, and I went with Teladoc, because many people think that virtual care, telemedicine is super easy. The thing is that it's crazy hard to get a network of doctors and patients to use a network. And then there's all the information that a company like Teladoc is accumulating, which in the world of artificial intelligence, and remember, Teladoc bought this artificial intelligence company called Livongo. People say they overpaid for it. In hindsight, I believe it's going to be seen that that was a complete and utter bargain. So those are three examples of the kinds of investments that I believe are going to be dominant, that are going to rule in this new era for markets: Bitcoin, Tesla, Teladoc. And you want examples of others? That's what I exclusively focus on at atgdigital.media. Also, you can sort of get an introduction to it on my Substack, so check those things out. And if you don't want to do any of that, at least give us a thumbs up, subscribe to the channel, and come back next week. This is Paul saying